What if the biggest gains you've ever made weren't proof that you're smart, but proof that you got lucky at the perfect time? And what if the same force that made you feel like a genius is quietly setting you up for your worst loss yet? Meet Dave. Dave has been trading for 2 years. His portfolio is up. He hit one explosive crypto trade. He discovered weekly options. He talks about conviction and macro. He thinks risk is something you manage after you win. 3 months ago, Dave maxed out on out-of-the-money calls because momentum doesn't just die. He didn't think he was gambling. He thought he had an edge. And here's the uncomfortable part. At some point, I was Dave. Not the meme version, not the caricature, but the mindset. The subtle shift that happens when a few wins start feeling like evidence, when green days feel like validation, when you stop asking whether the market is carrying you and start believing you're carrying the market. Welcome back to Financial Mindset. I used to laugh at guys like Dave, the overconfident retail trader who thinks 2 years of upside makes him battle-tested. But the longer I've been in markets, the more I've started asking a question that won't leave me alone. What if Dave isn't dumb? What if Dave is exactly what this market was designed to create? Because when you drop almost anyone into a decade-plus bull run, flood the system with liquidity, reward volatility, and punish caution, something changes. Aggression looks like intelligence. Leverage feels rational. Doubt feels outdated. And that's what scares me, not Dave's confidence. But how easy it is to mistake the environment for skill. If you've ever felt invincible in a rising market, this conversation is for you. Subscribe to the channel if you want more honest breakdowns like this, because what we're about to unpack might change the way you see your own returns. And to understand whether it's skill or just the tide lifting all boats, we have to zoom out. Since 2009, we've been living through one of the most forgiving market environments in modern history. 17 years of expansion, massive liquidity injections, interest rates pinned near zero for long stretches. Every meaningful sell-off met with stimulus, reassurance, or both. If you were long risk, the wind was at your back more often than not. I didn't fully appreciate that at first. When I looked at my returns, I saw decisions, I saw timing, I saw insight. What I didn't see was the backdrop quietly amplifying everything I touched. Growth stocks weren't just rising because they were revolutionary. They were rising because capital was cheap and abundant. Risk wasn't just tolerated, it was rewarded. Then 2020 hit and things accelerated. Retail participation exploded. Options volume surged. High-growth tech names detached from traditional valuation anchors. Crypto turned into a cultural movement. If you were aggressive, concentrated, and willing to stomach volatility, you didn't just keep up with the market, you often crushed it. And that kind of outperformance does something psychological. It shifts your baseline. Suddenly, a 10% annual return feels mediocre. Diversification feels unnecessary. Caution feels like fear masquerading as wisdom. I remember thinking that the old rules had simply become obsolete, that maybe we were in a new era where speed beat patience and conviction beat caution. But the more I studied past cycles, the more uneasy I became, because every prolonged expansion in history has created the same illusion, that the current conditions are permanent. The market wasn't just generating returns, it was generating confidence. And confidence, when compounded for long enough, starts to feel like competence. And that's where psychology quietly steps in and turns confidence into something far more dangerous. The Dunning-Kruger effect isn't just an academic theory to me anymore. It's a pattern I've watched unfold in real time, sometimes in other people, sometimes uncomfortably in myself. At its core, it describes how people with limited knowledge tend to overestimate their competence, while those with deeper understanding often question themselves more. In markets, that curve isn't gradual, it's amplified. Early success in investing is intoxicating. Your first breakout trade works. Your second momentum play doubles. You take a slightly bigger position next time, and that works too. The feedback loop is immediate and positive. There's no professor grading your logic. The market just pays you. And when you get paid, your brain doesn't ask whether the macro backdrop helped you. It assumes causation. I made money, therefore I was right. I remember the first time I started sizing up aggressively after a string of wins. It didn't feel reckless, it felt earned. I had proof. Charts made sense. Narratives connected. I wasn't guessing. I was interpreting. But what I didn't realize was how shallow my understanding actually was. I knew how to ride strength, but not how to dissect balance sheets in a tightening cycle. I understood momentum, but not fragility. That's the trap. The market, especially in a forgiving regime, rewards partial understanding with full confidence. It doesn't expose your blind spots immediately. It hides them behind green candles. And when losses eventually arrive, they don't just hit your portfolio. They hit your identity. And when I started asking why those swings felt so extreme, I realized there was a structural force underneath all of it that I had barely paid attention to. That force is beta. For a long time, I treated beta like a textbook term, something analysts referenced on earnings calls, but not something that shaped my daily decisions. But once I understood it, I couldn't unsee it. Beta is simply a measure of how much a stock moves relative to the broader market. A beta above 1 means amplified movement. If the market rises, the stock tends to rise more. If the market falls, it tends to fall harder. On the surface, that sounds neutral. In reality, it explains almost everything about why aggressive portfolios look brilliant in rising environments. When the market climbs steadily, high beta names accelerate. Growth stocks, speculative tech, leveraged ETFs, they don't just participate, they magnify. A 2% move in the index becomes a 3 or 4% move in your portfolio. Stack that over months, and you're not just keeping pace, you're outperforming. It feels like alpha, it feels like insight. But what I slowly came to terms with was that I wasn't necessarily selecting superior businesses. I was selecting volatility. I was choosing assets designed to swing wider. In an expansion, that choice looks intelligent. In a contraction, it looks reckless. Most retail portfolios, whether intentionally or not, lean high beta. We gravitate towards stories with explosive upside. We concentrate, we add leverage, we overlay options. Structurally, we build portfolios that amplify the market's mood. And that amplification is intoxicating on the way up. It reinforces the narrative that we're ahead of the curve, that we see what others don't. It turns a good year into proof of skill. But beta doesn't reward conviction. It rewards direction. When liquidity tightens and risk appetite fades, the same multiplier that once inflated gains begins compounding losses. That's when the illusion fades. Not because intelligence suddenly disappears, but because the underlying force driving outperformance was never intelligence to begin with. It was exposure. And exposure cuts both ways. And the moment you accept that exposure, not brilliance, drove most of the upside, you're forced to confront a harder question. What happens when the direction changes? Market cycles don't reverse with dramatic music playing in the background. They shift quietly at first. Liquidity tightens a little. Credit conditions get slightly stricter. Earnings stop surprising to the upside. The same narratives that once fueled momentum begin to lose oxygen. At first, it feels temporary. Another dip to buy. Another overreaction. Until it isn't. What unsettles me isn't volatility itself. It's how deeply identity gets entangled with performance during long expansions. When you've spent years being rewarded for aggression, caution feels like betrayal. Scaling back feels like weakness. Holding cash feels like admitting you don't know what's next. I don't see Dave as foolish anymore. I see him as someone optimized for a specific regime. He built a strategy that thrived in abundance. The real danger wasn't his confidence. It was his assumption that the environment would stay the same. I've had to wrestle with that assumption myself. The temptation to stay fully exposed, to keep pressing when the scoreboard has been favorable, is strong. There's always a reason to believe the cycle can stretch a little longer. But surviving markets isn't about looking smart during euphoria. It's about maintaining flexibility when conditions change. High beta exposure can create extraordinary gains in the right phase, but it demands humility when that phase matures. If bull markets reward boldness, bear markets reward restraint. And the investors who endure aren't necessarily the most aggressive or the most confident. They're the ones willing to question whether their success came from skill or from standing in the right place at the right time. Bull markets can disguise exposure as brilliance and momentum as mastery. The danger isn't volatility itself, but the illusion of control it creates. When conditions shift, confidence gets tested. The real edge isn't winning loudly in good times, it's staying grounded enough to survive the turn. The deeper lesson is humility. In markets and in life, success often depends on timing and environment more than we admit. Instead of attaching your identity to wins, build resilience. Save during expansions. Diversify your skills. Question your assumptions when things feel easy. Sustainable growth comes from awareness, not ego. Here's a simple question for you. Do you think your biggest wins came more from skill or from timing? Share your answer in the comments so we can all learn from different perspectives. And if this helped you think differently, please subscribe to support the channel and keep these conversations going.